You want to be a great investor? You want to actually understand what you're doing with your money? Watch this video and learn about the 7 principles of the greatest investor of all time. Like we talked in the last video, Warren Buffett is the most well-known investor of all time and helped make value investing popular. He used 7 principles that helped him invest in good companies. Let's see what they are. First, managers must have integrity and talent. Like in sports, you want a team that has a good management and a strong captain at the wheel. Companies are no different. You want a team that can achieve the potential you think the company has. Integrity is also very important. You want people that are transparent in their goals and that work to achieve them. You want to be able to count on them. You have to remember that you are giving your money for a chance of a better return, and the company is that chance. Would you give your money to someone you perceive as incompetent or bad at their job? Never. So why would you buy a stock without looking at who is actually operating the company? Second, invest by facts, not emotions. The market is emotional and not rational. Make a good plan and follow it. Emotion should not be part of that plan. This point can be the difference between a bad investor and a strong one. You won't always be right, you will sometimes be wrong. It's weird to say it like that, but once you've met your strategy, you need to follow it like a robot. No place for emotion. Third, buy wonderful businesses, not cigar butts. Buffett gives the example of someone walking on the street and seeing a disgusting cigar on the ground with a puff left. Some people will take the last puff because it's cheap, free. Some people do the same mistakes with stocks. Better buy a wonderful business at a fair price than a fair business at a wonderful price. We often hear in dividend investing to not chase the yields. Well, in investing, don't chase low prices. There is no excuse in today's market to chase low-value stocks since you can buy fractional shares with pretty much any of the big broker. 4. Only buy stocks that you understand. Don't chase stocks just because everyone else is trading but you don't know anything about. You need to be able to understand the process behind the company and the market she's in to make a clear decision. In your investing research, you will read about a lot of things. You won't only look at the company's numbers, but also at things like the market they operate in and the future of that market. To make a good decision here, you need to understand the market to even start to have a chance to be right. Think about this. There is a lot of experts in a lot of different fields of work in market that can't predict the future of these markets. How could you without even understanding it? At this point, it's pretty much a gamble. 5. When you see a great opportunity, take it. Like the point number 2, make a plan and follow the plan. If your structure recommends a stock and you're sure you've done a good job analyzing it, pull the trigger. You won't have a lot of great opportunities, so you have to grab them. Buffett also said that doing these investments on a small scale is almost as big of a mistake as not taking them at all. 6. For long-term investors, don't sell unless the business fundamentally change. It's also a good idea to analyze the company fundamentals after earnings or yearly to see if the value you originally saw is still there. Don't sell just because the price gets too high or too low. Of course, if you follow the price and you think that it becomes way higher than the intrinsic value, you have reason to sell. But don't sell just because you've made 20, 50, or even 200%. 7. Buy at a price below intrinsic value. This requires some fundamental analysis skill. This is also the base of value investing. This means that you first have to calculate the intrinsic value. I will post an example of this process in another video soon, so don't forget to subscribe if you don't want to miss it. The principles of value investing is simple. Calculate how much you think the stock is worth, which is the intrinsic value. Is the actual price lower? Yes? Buy. It's not? Don't. Of course, the hard part is to be good at calculating that price and how it can evolve in time, but this is for another day. So, you just want to be a better investor? You just have to follow these 7 points and you will. As always, comment, like, and subscribe if you've liked the video and want to be a better investor in the future. Have a good day, everyone.